Welcome to Flip the Cap, the insurance industry's premier podcast. I'm your host, Kathryn Smith, and I can't wait to pop the top on all things property insurance with you today, sharing alternative capital trends, things happening in the property marketplace, how to best position your insureds for their upcoming renewals, and much more. On today's episode of Flip the Cap, I am thrilled to have Ben Beazley join me. Welcome.
Thank you.
Ben is Jencap's Executive Vice President of our property division. We'll talk more about his new role at Jencap a little bit later in the podcast, but I want to quickly recap the longevity and the significance of your property experience, specifically as it relates to MGAs, which you've dedicated your entire career to that sector. Ben has held senior roles at RT Specialty, Chartwell, Independent Insurance Brokers, Sweat & Crawford, and Tri-City, and most recently, Ben was a partner at PPS Specialty Underwriters. So without further ado, let's pop the top and get into it. First of all, I really appreciate you being here. Thank you. I like to start the podcast with a couple of getting to know you questions. Insurance is fun and all, but you are super interesting too. So I want to start with the obvious, which is you're not from the South. You have a different accent.
No, I'm not.
So tell us where you're from.
I'm from London originally. I came over to the States in 1987, and rather fortuitously, I came over for a 6-month stint in Atlanta, and then it wasn't 2 weeks after I arrived that I saw how much more efficiently insurance was placed in the States. I was working on a particular property account, and I managed to place a $5 million primary in a 10-minute phone conversation, which would have taken 2 weeks of walking around Lloyd's. And so I decided that this probably was a better place to do business. It also didn't hurt that I had the English accent, because people thought I knew more about insurance than I actually did. But over the years, I've picked it up.
You also have a very specific spelling to your last name, which is a very common Lloyd's Syndicate name. Do you have any relation there?
I do. That was Andrew Beazley was my brother. Sometimes I tell the story that London was only big enough for one Beazley, and being the younger brother, I was the one put on the boat and sent over to the colonies. He chose obviously and the underwriting area of insurance and was super successful in that. And then I took the brokering course.
Gotcha. I'm going to switch gears on the insurance piece and just ask you a couple of completely random questions to get to know you. First question is, what's one of your top bucket list items, and why is that one of your top bucket list items?
I would have to say it'd have to be travel. I'm very interested in seeing other cultures around the world. Obviously, from being from Europe, I did have the benefit of traveling to European countries quite a bit when I was growing up. But there are places, New Zealand, Africa, South America, yet uncharted waters for me, and I look forward to doing some of those trips later on in my life.
If you could pick a celebrity figure in time to meet, who would it be? I know that's a tough one.
Well, I think probably there may be two. Winston Churchill would be one, and I think Jimmy Spithill might be the other. You might not be familiar with the last name. Jimmy Spithill was actually the skipper of the America's Cup boat in 2013, and it was the greatest comeback in sporting history from an 8-1 deficit to win by 9-8. And just thinking about what must have gone through his mind during that time to actually get over all his anxiety and to work diligently to find a way to win is quite representative actually of our business and what we do in business. Winston Churchill, I named Chartwell my brokerage operation after Winston Churchill. After his home, Chartwell, which was only a mile down the road from where I grew up. And obviously everyone knows how inspiring he was. He was a man for the moment, obviously. But his words resonated so much and helped the country and indeed the world to get over, and through the war which was tremendous.
When you aren't working, what's something that we could find you doing?
When
you aren't working.
I should probably say I'm always working. No, I mean I love gardening. I am very fond of the water. Another reason I like Jimmy. I love being out on boats, but that's not not that capable of doing that right here in Atlanta. So no, golf and fishing, fly fishing, and two other pastimes that I enjoy doing.
I remember you mentioning something about woodworking also.
Yes, yeah, I do like carpentry. And my father was actually, I wish he had become a carpenter instead of a solicitor, because I think he would have much preferred his life. But I enjoy working with my hands.
That probably signs you up for a lot of tasks, doesn't it?
my wife asked me to. She said she wanted a raised bed vegetable garden back in the beginning of COVID, and I thought, well, this will take a couple of weeks to do, and 3 months later she got her raised bed vegetable garden. But it certainly produces a lot of good food.
So you're very, very dedicated to mentoring not just existing brokers in the insurance industry, but also trying to find that next generation of talent to bring into the industry. Mm-hmm. So based on your wealth of experience, what is a piece of advice that you would give to somebody looking to come into the insurance industry for the first time?
So I think young people today, and many old people today, are impatient, and I think that you still have to learn our industry. I would say that wholesale brokering is not particularly difficult. It just requires someone that has the will to win and the will to learn. Young people coming in, I rather like the expression packed, to be patient, to appreciate that you need to learn and the process, to make a commitment to the process, and to trust that if you do those things that you will be or have the best chance for success down the road.
You're one of the most highly coveted property brokers in our industry. So of all the places that you could work, what made you choose to come work at Jencap?
Highly coveted, I wouldn't say that. I've obviously had a lot.
I've
had a lot of experience, and I've been very fortunate. I've been very fortunate to work with some of the greatest people in our industry, and I've learned from them. And I would say that those people exist in Jencap, which is one of the main reasons that I joined Jencap. I think the exciting thing about Jencap is it's what I would call an emerging wholesaler. You have the markets. All the markets you need to be successful. You have great leadership, and there's a culture about this company that is absolutely imperative in this marketplace, which is an ability or a desire to communicate with each other and to work as a team for the success of our clients. And that will only equal success if we actually walk the talk.
We're going to take a quick break, and when we come back, Ben is going to be in the hot seat, and he's going to flip the cap.
Flip the Cap is brought to you by Jencap. Jencap is one of the largest wholesale intermediaries in the United States, with expertise in wholesale brokerage, binding authority, and program management. Jencap has specialized divisions and affiliate companies that provide niche expertise, unparalleled market access, and nationwide influence. Encompassing expertise from every corner of the industry, Jencap is the ultimate award-winning insurance family. Put Jencap to work for you.
We're back, and you're listening to Flip the Cap, the insurance industry's premier podcast where insurance insights flow and trending topics are always on tap. My special guest, Ben Beazley, is the Executive Vice President of Property for Jencap. And coming up, he's going to weigh in on alternative capital happening in the marketplace, what he foresees being the big property trends coming up in 2023, how to position your insureds for success, and more. But first, you're stuck with playing Flip the Cap, which I make all of my guests do. The rules are very simple. You just have to channel your college Ben and think back
didn't go to college, but
channel
high school Ben. Yes, maybe
your younger beer game Ben.
Yeah.
So what you'll do is you'll have a traditional bottle cap. The goal, get the cap in the cup. As you can see on our leaderboard, Deb Diaguardi, our head of professional lines for Jencap, has
set the bar.
So the only rule here is your elbow and or hand cannot go past the table line. Okay. Otherwise, it's
Oh, you're not going to demo for me?
If you really want me to.
That's fine. And I'm not bouncing it. In my day,
you're not bouncing. You're throwing.
Okay.
But I've got full faith in you. You're going to be.
Nope.
You're going to be leaderboard winner here. In no time.
Not with that.
All right. You got this. Close. 3.
There we go.
All right.
Not too bad.
Kanan, you're going down. Mark, you're going down.
And I want Deb to know I only did that for her because I wanted her to keep the top spot because I met her in New York and she's a super lady. So there we go.
How thoughtful of you. We're back, and I'm here with special guest Ben Beazley, Jencap Executive Vice President of Property. And now that we've gotten all of our getting to know you questions out of the way, I've forced you to play a game the second you got here. We're going to dig into some property-specific topics and trends. The first thing that I want to talk to you about is alternative capital. Mm-hmm. So between 2008 and 2014, alternative capital tripled coming into the marketplace. Mm-hmm. So what have you seen happening with alternative capital over the last couple of years, and how has that impacted property insurance?
Well, it's continued to come into the market, but with the market hardening and then really with interest rates going up and inflation in the last 16 months, it has fallen off. With interest going up, a lot of that capital can go and realize returns elsewhere in the marketplace. Also, I would suggest that maybe the returns weren't there for the capital when it did come into the marketplace. As much as it would like. Obviously, the market is a lot harder now, but you're seeing constant adjustments to try and get to a more consistent profitability for that capital in the marketplace. So I think that's why you're seeing an adjustment in the way accounts are placed, and I think it's probably for the better.
Could you give an example of what you mean by the way that accounts are being placed?
Well, rather than one company, one pot of capital, taking a large chunk of a given account, there is more of a sharing and layering of the risk, which is very Lloyd's-esque, and it was all about sharing a risk amongst many so that no one individual or one entity went down in the face of a catastrophe. And that can only lead to better stability in the market. So it's exciting times, but with exciting times comes a very new way of going about placing accounts. And it requires a certain amount of expertise. And unfortunately, our industry hasn't been training people for the last 20 years, really, because the market's been so soft. And I think that's why I was bought out of mothballs. So I think there are a lot of the younger people are not used to how to go about delivering the message in a hard market and to go about structuring accounts. I would actually argue that there are people that have come into the industry and have retired from the industry and never saw a market like we're experiencing now. So it's a bit of new ground for all of us, and it's exciting on one hand, but not so thrilling, I think, for the insureds out there, because insurance is something. And for young people coming into the industry, this is a good thing. Insurance is something that is always needed. That if you have a loan on your assets, you're going to require insurance. So we're very insulated from what goes on in the rest of the world. It provides great job security. So
yeah, agreed. Do you expect business coming through wholesalers in the coming year in 2023 to increase, decrease, or to maintain?
Well, I think probably it's going to continue increasing. I mean, if you go back to 2008, I think and there are lots of different sources of this information, but it's in the mid-teens, maybe $16 billion of premium went into what we historically knew as the excess and surplus lines or wholesale marketplace. And by 2020, 12 years later, we were up around $80 billion of premium coming into the market, or coming into the wholesale marketplace. And that's because a lot of the retailers decided to outsource the expertise in marketing accounts to the wholesale broker. And for the 5 points that they had to give up in commission, they were able to take a lot more expense off their bottom line by getting rid of marketing departments. And it provided their clients a much greater depth in casualty, property, professional liability, whatever the line of coverage was. So I think that trend is going to continue. I see no reason why it'll stop. And certainly as long as the market continues hardening, which I think it's going to through this year, we will see more premium, more accounts, and because the market is going up, more premium coming into our area of expertise.
How would you describe the state of the property marketplace so far in Q1? We've talked about it a little bit as it relates to alternative capital, but in a broad sense, what's happening in the property market?
It's uncharted waters. Most people in America who are in our industry have never experienced what we're seeing now. One of the main contributing factors is that actuaries are running the companies, the insurance companies, and therefore they're looking at the numbers in a purely number basis. The actual underwriting of the risk is somewhat secondary, and no one wants to take that walk down the corridor to say that we've had a substantial loss and I took 100% of a layer. So there's a lot more sharing going on. I liken it, and it's rather a basic analogy, but I liken it to a jigsaw puzzle. I mean, every account of any size, even a relative middle market account these days, is getting all the markets to say what they're willing to do and then putting the pieces in place to come up with the best solution for the client. And so it makes the job a lot harder in many respects, but it also makes it a lot more rewarding also.
You talked about the need for layering to get the capacity that you need for a risk. What about rate? What about retentions?
Well, if we can feed a little bit into what we've seen in the reinsurance side in the first couple of months of this year, a lot of treaties renewed on 1/1. I was over in Bermuda last week and got to meet about 9 different insurance companies and spend time with them. And the overriding message is that reinsurers are looking for what one person categorized as half the limit, double the premium, and double the retention. Mm-hmm. So I think that methodology is flowing through to the insureds, and what insureds need to do with their clients and with the wholesaler is really dig into what is going to get me my best rate of return. Do I take a much higher retention and normalize or reduce my premium sum, or how does the structure best work where I can make sense of it? And it's unfortunately not a pretty sight out there right now.
We're almost 2 full months into the year. We've got a long way to go. Is there any specific trend or something that you foresee playing out that we may not necessarily see today as the year progresses in the property marketplace? Or just more of the same?
Well, I mean, look at the amount of snowfall we had this last weekend out on the West Coast. I mean, it was actually snowing, I think, on the coast in California, which is unheard of. So if you had a sudden heating up of temperatures on the West Coast and the Sierras, you could have more flooding going on out in the West Coast. There's always the concern about convective storms, which last year were relatively mundane. Of course, we had a lot of other issues, with not least of all the Hurricane Ian in October of last year. So you never know what might happen. The important thing is that approximately 70% of property risks renew in the first 6 months of the year, and we're just coming into our really busy season. So nothing's going to change between now and when we enter the next hurricane season, and hopefully it's a benign year, and the waters will settle a little bit, but it's still very choppy waters and will be for the foreseeable future.
You mentioned Hurricane Ian and a couple of the just general weather trends that are completely unprecedented. Call it climate change, call it what have you. But how much do models impact property underwriting?
Tremendously. They're I won't say a necessary evil, but they're definitely necessary. I mean, there's a big question about the validity of the models, whether it's earthquake, named storm, convective storm, or now wildfire. But unfortunately, it is the only measure that insurers can use to monitor their books of business and their aggregation of exposure. So getting accurate information from insureds about the risk is absolutely critical. Good information in will present or give the best result when it comes to the model. But you can't get around it. I mean, modeling is here to stay. In fact, with wildfire, we've just signed up with a wildfire modeling company, which I worked with during my last couple of years when I was consulting. Super impressed with what they've developed, and also really appreciate how transparent they are and how they developed the model. And it's endorsed by the California Department of Insurance, and it's being utilized by some major insurance companies. We in turn have been successful in demonstrating it to a couple of or few insurance companies and getting them to work with us. And it gives a far more accurate assessment of the risk on a location basis, as opposed to many of these models that are a lot more broad brush. They'll take a zip code, and if the zip code touches a wildlife area, then it means the whole zip code is bad, which just is not the case. And unfortunately, there are a lot of great insureds in California that have been affected by a lack of true understanding in the past few years, which is now getting much better, which is great. We are the first wholesaler to work with Zesty, and we did that because insurance companies definitely seem willing to understand it, and it does give a lot more of an accurate read on the exposure. And Zesty they work on wildfire not only in California, but also in Colorado and up in the Northwest. And they're about to release convective windstorm and named windstorm models as well. And I think because of their transparent approach, it's going to help the insurance companies have more confidence in the product.
We've talked about how many market pressures are out there in the property insurance world. Don't envy the job that you and your colleagues have in underwriting property business right now. But for our retail partners, what can they be doing or have their insureds do proactively to make it a smoother and better renewal process and really set them up for success? Because obviously it's challenging for wholesalers and retail agents to underwrite the business and to place it and to sell it, but it's tough for the insureds too. They particularly don't understand all of the behind the scenes things that are happening, but they're getting hit with the rate increases and sorry, we're going to cut your coverage and ask you for double the premium. Mm-hmm. That's really hard for them too. So I guess for everybody involved, how do we set these clients up for success in the renewal process with what's going on in the marketplace?
Well, I'll go back to something that happened actually right after Katrina. I had occasion to be asked to attend a meeting with an insured who had no idea what a wholesaler was and what our role was in the insurance contract or the formation of marketing and forming an insurance contract. And I think it starts with the wholesale broker working with our retail clients very closely and having a joint discussion with the insured to explain the whole marketing process and what can be expected out there. There's no point in trying to pull wool over anyone's eyes in this market and say, you've had a clean loss record, it's going to be fine. I was at a symposium out in Las Vegas 3 weeks ago, and certainly the insurance carriers that were there that spoke at this weren't pulling the wool at all. I mean, you could have a clean loss ratio, you're still going to be looking at increases in retention, increases in pricing, and maybe a reduction in coverage. So being completely upfront and open about it. Then it comes down to the quality of information, and not least of all the values that we're working with. The valuation has become a massive topic because it's been the elephant in the room for 20 years and it's never really been addressed. And now you have to have accurate valuation. And if you've been getting away on your apartment complex at $80 a square foot, you're going to have to now look at $120, $130 a square foot, depending. Could be $180 a square foot in California. So even if your rate stayed the same, you can do the math, you're obviously going to be looking at a substantial premium increase over what you're used to. So it's understanding the factors that go into the risk assessment, what underwriters are looking for, and making sure the information is accurate. And then underwriters definitely react better if the insured is willing to participate in loss. So that means taking a higher retention, and the broker and the insured, they need to talk about financially, what does that look like? I mean, how much could you take on in the way of retention? Because then the insurance companies view that as an alignment of interest and a partnership, really. So that helps. So that combined with us working on the modeling and what goes into the modeling will set them up for the best result.
What are some of the inputs that are contributing to those valuation factors going up for property?
Cost of material and labor. I mean, it's ridiculous.
Just across the board.
Across the board.
It's not
ridiculous.
a specific.
No, we were at $60 a square foot for frame apartments in Texas for the last 20 years. Well, there is no way that you can build anything today, I would argue, for less than, maybe $120, double that price. So and that combined with the activities of public adjusters out there, they have not helped the situation. They might think that they've helped, but they've actually just only helped to inflate claims costs, and the insurance companies have to react to that. So so that's a big problem.
All right, Ben, last question. This should be your easiest one yet. You have worked in several different wholesale environments throughout your career, and I know you've just now been at Jencap for 3 months, but for the retail agents listening to the podcast today, what would you say is really the Jencap advantage of why they should entrust us with their property business over the competitors that we have in this industry?
I think what might set us apart is a culture that actually existed at Tri-City Brokerage back when I worked there in the 90s, and many of the people that work here at Jencap were from that company, and it was the collaboration. I think that's the key word. In this market, you have to have collaboration, not only collaboration with the agent and with the insured, but we have to be collaborative internally, and we talk about that. I think there are challenges on collaboration in some of the larger brokers because it is they have an enormous amount of business. It's difficult to collaborate. Plus, they're somewhat protective of their own domain. We are just emerging. We're having a national property meeting here on Thursday. Bringing everybody in from around the country, which I'm super excited about, talking about our market relationships and how we can best work with one another. And I think for any agent in this market, you want to feel like you're bringing a team to the fight, not just an individual, and hope that that individual is going to bring all the weaponry you need. You're going to have more chance of getting what you need in this market to get the best results when you've got a team of experts bringing all their bows and arrows to the fight.
Right. And it may not be, you might not need a collaborative approach on every deal, but you might need to leverage some geographic expertise, a carrier relationship, a market access, whatever the case may be.
Yep.
How is our property division structured in such a way that it would, benefit our retail partners?
Well, we have expertise on the West Coast, on the East Coast. We're looking to build, obviously, in various different areas. But the way the team is quite a small team, and when you've got sometimes when you've got a smaller group of senior brokers in a company, it's easier to work with and have that collaboration work. And so far, what I've seen works very effectively, and out of it has born great success. And indeed, I have seen us win accounts for our clients against some of the big retailers who are aligned with the biggest wholesalers out there. So I've seen proof in the pudding that a bit of David and Goliath syndrome. So we're definitely being successful. Within Jencap, we do have designated silos, which are very useful. You have the binding authority group in various different areas of the country. We have Paragon, the MGA unit, and then we have the brokerage part. So we're able to feed off those different silos as well, and bringing solutions as a one-stop shop to our clients.
That's great. I want to keep talking. I could keep talking to you about this forever, but unfortunately, our time is up. Ben, I really, really appreciate you joining me. Thank you. I know that our viewers are going to love hearing your property insights and learning a little bit more about you. I'm your host, Kathryn Smith. Flip the Cap is the insurance industry's premier podcast where insurance insights flow and trending topics are always on tap. We'll see you next time.